Okay, thank you. All right, let's have Mr. Machine tell you what's up.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker, a registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on its specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How's everybody doing? We had a fun day yesterday, and we'll see how today goes. So we got a little bounce so far. Let's take a look at the indexes, see how they're looking. No, not that one. Not huge, but, you know, it is what it is. What is this? What is that? RBV6. What are we up to? We got to be past that. That's why it's a dead contract. There we go. Everything else looks in order. Anyway, so, well, we were having a bit of a bounce, but we died out. Now, here's the question. Where did we die out? What were we looking for this morning? Let's see how good the 5% rule is behaving. What? This is not right. Why would you do this to me? There we go. So this morning we were looking at, here. So we were looking for, let's see if I can make that small. Yeah, there we go. Make that small. And do that. And now, make that small. Let's try this again. Put it there. Now we go to finger swim. And make that small, I guess. Oh, it's already small. Ooh, it doesn't like that, does it? All right, how about, this is tricky. Let's make it big again. Or if I simply move it over a little bit. No. Big. Oh, I see. Now I completely screwed it up. Wow, it really hates doing this. All right. Wait, what if I, nope, won't let me do that either. Interesting. Oh, here we go, wait. There, figured it out. Oh, no. There. I don't know what that is. It made a new one. All right, let's try that again. So, what were we looking for? We were looking for, on the Dow, isn't that funny, 18,075. That's a weak bounce on the Dow. That's what our 5% rule predicts. On the S&P, a weak bounce, 2134, and we're at 2135. On the NASDAQ, 4820. We're at 4820. Oh, man, and the Russell's nowhere close. And the Russell, we were looking for 1226, and it's at 12. Oh, no, I'm sorry, it's at 1226. 4 for 4. Don't tell me the Nikkei can do, oh, look at the Nikkei. So close. We were almost 5 for 5. That is hysterical. And the Nikkei is at 16,980. So, what we have here, see, when I say that, when I say this, this is what I mean. What we have here are just weak bounces. And I don't know if I can be any more clear about that. I mean, we wrote this It had to be like 7:30, 8 o'clock when I was writing this. It's a mathematical fact. This is what a weak bounce is off a drop like that. Basically what we've had here is, remember that the market is like, physics apply to the market. It's like a ball that ran out of energy, okay? It bounced, it went up, and now it's coming back down. And what we have here is losing energy. It went up, came down, it bounced strong, first bounce, second bounce is now weak, so the strong bounce failed, and now the weak bounce is failing. And when they fail exactly where you predict them to be failing, that's not good. Okay, it means what we're probably doing here is consolidating for a move lower, not a move higher. And we'll just have to see on the momentum. Also, that lines up with what we were talking about. You guys get the picture here. That lines up with what we were talking about last week. Where is that? Was it last week? No, Monday. Seems like a week ago. This week's going slowly, so probably from not eating today. It's really bugging me. So let's see. Last week we were looking at the Fed, right? Not last week. Monday we were looking at the Fed, and we said, here's the thing. We did this chart, and it was Dove, Super Dove, Lisa's Super Dove, Hawk, that's the George, right? Then we have Hawk. So Harker is a hawk, Rosengren's a hawk, and then Yellen speaks. Right now we're waiting for the Fed minutes. So the market's kind of just, bouncing along into the Fed weekly. And unless the Fed says something that the market likes, it's going to go lower. And we already know that there were 3 dissenters to the Fed of staying on hold. So what the tea leaves are going to be is like, okay, we know 3 people absolutely want to raise rates. There's only 4 other people voting. So the question is, what do those people think? And then the attention will shift. Now, Harker's going to make his hawkish case, and Rosengren's going to make his hawkish case, and then Yellen is going to say whatever she says at 12:30. All right, but don't forget at this moment, right now, 1 o'clock, they got the 3-year note auction and the 10-year note auction. So they're selling a couple of $100 billion worth of notes right now, $100 and something billion worth of notes right now. So they don't want the market to be strong looking when they're trying to sell you notes at 0%. So they want the market to be weak right now. I'm puzzled that there's no Duggan here. That's what's weird. So I'm wondering if the minutes are going to be a bit more dovish than people think. Because it seems odd to me that they wouldn't try to reverse any kind of downtrend here, especially if the Fed meeting minutes are hawkish. So interestingly, I'm kind of wondering if these Fed minutes are going to be a bit more dovish than people think they are. So we'll see. Either way, though, they got a hike in December. They really do. But of course, I said that about the last meeting, and they never did. So what do I know? The Fed is a mystery to all of us. We had this lovely drop in oil, which, it's a shame when it does this, though, because now we can't play. We played 51 down over and over and over again, and now it's at 50. So I guess, next drop will be hopefully 50 down to 49, and we'll play that a few times, and then it'll drop down to 48.50, and then we'll hopefully get down to 47.50, and we'll be in good shape. Not that we're not in good shape now, but it's I'm expecting a much bigger drop. See if we have any questions before I ramble on. Where are my things? There. So let's see. Nope, nobody has a question. Fantastic. So I can just say whatever I want. All right. Let's just continue then. Where my fingers is. So on the whole, look, on the daily view, look, there's not much damage being done here. We've been drifting along for months. We're still drifting along in the same place, but we're moving a bit lower in the range. The NASDAQ has been our superstar. Notice, look at the difference, though, right? These guys are below, and the NASDAQ is being like, hey, I don't care. He's a mile above where he was back in the end of July. Not like at all. These guys are below July, and the Russell is above July, but not as much as the NASDAQ. So these two guys have been runaway up, and they could correct harshly if we start heading back down. Even the Nikkei is up since July. That's a weird one, huh? This country is completely falling apart, and Europe is up, and Germany's up. And we're still watching this 3,000 line very carefully. So we move back to a shorter term. Everyone is correcting together at the moment. And so over the long haul, you start seeing things catch up to each other. In a much longer perspective, you see, again, everyone started out about here except the Russell, which was high, way high. But what happened in the end? In the end, the Russell went lower, or proportionally went lower, except for that, it went basically as much as anyone else. So when I say that, that's what I mean. The NASDAQ and the Russell are higher than the others, but they'll correct just the same. So proportionally, they're likely to fall harder than the rest, which is why in the short-term portfolio, and I think also the options opportunity portfolio, we're focused on SQQQ and TZA, the ultra-short Russell and the ultra-short NASDAQ are our principal hedges, because those guys are the most above their trend lines, and therefore they're the most likely to correct. And that goes back to the good old tugboat theory of the markets, which is you have to think of the indexes like a bunch of tugboats, and you know how tugboats are. They have ropes that attach them to the big boat, right? And they all pull the big boat. And when they all pull together, they can move the big boat, and consider the big boat to be like the actual market level, the hard level the market sets at. So if they all move up together, they can move the total market level to a higher level, and it can stay there. But when they all go off in different directions, then the main level of the market's going to stay where it is. And another more important thing, though, is if you visualize all the little ropes, they can't go too far away from each other. One can't go way off to the right. One can't go way up while one goes way down. It doesn't work like that. Okay, at a certain point, their little ropes go tight, and until they move the big boat by doing something together, they're going to keep coming back to it whenever they stress out, whenever they get too far away. So that's what I mean when I talk about tugboats. It's like you have to think about that these indexes are connected. And look, a lot of them some of them have the same stocks in them, for one thing. Apple dominates the Dow, the NASDAQ, and the S&P. Apple's a dominant trade in all three indexes. So it's really ridiculous. I mean, but that's the way it is. You can't do anything about it. So if Apple does well, the whole market tends to do well. And if Apple, for some reason, did poorly, the whole market would do poorly. But Apple, and I hate this. Fortunately on Apple, they changed stock chart. I just don't like this display in the middle. It's awful. I don't know why they did this. It annoys the crap out of me. It's also smaller. So Apple, when Apple does well, the market does well. When Apple does poorly, the market it puts a drag on the market. But when Apple finishes an up move, which is kind of getting towards finishing that move now, maybe they'll get to 130. But when it finishes an up move, then also the market loses a catalyst. Then it becomes dead weight. Then in fact, Apple then becomes the thing the tugboats are pulling, right? Because now everybody else has to move up and drag Apple with them somehow. Because Apple's the big boat. And if Apple starts going left, all those little boats are going to go wherever it goes. They're going to follow. So as far as that goes, Apple has such a huge influence over the market, and so much depends on whether or not they're in a good mood or a bad mood. All right, but also then again, if the whole market starts going down, they'll take Apple with it. Which is frankly good, though, because if you think about it, if the whole market sells off and Apple gets dragged down with the market for no good reason, yes, it exaggerates the sell-off, but that's also good because it means we know that, and then we can jump back in. And we know that Apple, which we've done over and over again, here, and here. We buy Apple, as I went over that yesterday in the thing. We talked about our Apple trade. We made a top trade alert every single time Apple did this. We made a top trade alert to buy Apple. every single time, because we say if it's Apple, when Apple goes down, just because the market went down, that's no reason not to buy Apple again. All right, so now we're getting to now. People have asked about this. We're at 120 on Apple. In let's see what portfolio comes up first. Okay, in the long-term portfolio. Where the hell is it? Oh, here it is. We do have some short calls. Okay. Well, we have a pretty long position because we have the 85 calls. So how's the long-term portfolio doing? 121. Yeah, we lost a bit. We have these 85 calls. And frankly, this isn't a big position. You know, it's actually, I mean, considering the portfolio, it's not a huge position. But we have these 85 calls, which are deep in the money. We sold some 110 calls in 2018, only a half cover though. So from 85 to 110 is what, like 30? 25. So it's 25 there plus an uncovered set. So they have no maximum gain. Then we have these short puts, which obviously are not even a worry. In fact, at this point, we're probably better off selling something else in 2019. Because, you know, the margin's the same. Right? So if we go to 2019, there's no difference between selling the 2019 95 and 2018 95. They're going to have the same margin. Let's see if we can find that. I think our swim decided to reset on me today for some reason. I had to reload a lot of stuff. All right. So these 95s are $5, and these 95s are $9, which isn't a big enough deal that I would roll it or anything like that. But what I'm saying is maybe it's only 5, so we could easily sell 5 more of like the hundreds. And that'll put another $5,000 in our pocket. We'll sell 5 more of the $100 2019 puts because we're very, very confident Apple's going to be more than 100 in 2019. So basically, we're just collecting $5,000. Now, if we do that, sell these and make it 5 and hit it. Look at the margin, $3,700 to collect 5. So I collect, it's super margin efficient. It's a great trade. So you're collecting $5,000, and you're only using $3,700 in net margin to do it. So why would we not? You know, for the long-term portfolio, there's no reason not to do a trade like that. It's like, do I want $5,000? Yes. Do I have $3,000 in margin sitting around? Yes. In fact, let's take a look. We have, in fact, well, the portfolio is up to $1 million or $1.1 million. Wow, that's crazy. I remember we were excited that like the two combined portfolios hit $1 million. That wasn't that long ago. So anyway, this guy's already $1.1 million, and now we've got 500,000 margin requirements. So theoretically, if you don't have an IRA, if you have an IRA, you have $1 million in margin. If you don't have an IRA, you have at least $2 million in margin. If you have portfolio margin, you might have $5 million in margin. But, you know, we assume $2 million in margin. So we're only using up a quarter of our margin in the long-term portfolio. That means we have $1.5 million of margin sitting around doing nothing. And we can collect $5,000 by using $3,700 of it in sell 5 Apple puts. So, boom, no-brainer, right? Every month, it's our job to find something we can collect $4,000 or $5,000 on. Okay? And it's like that's our chore for the long-term portfolios. Every month we want to sell at least one put that gets us, that brings in $5,000. And we want to sell it, of course, in a stock that we really want to own. And yes, we already sold some puts, but we only sold 5 puts in Apple. Since we only sold 5 puts, we can certainly sell 5 more. And by staggering it to 2019, then these will expire in a year, then those will expire in a year, then we'll sell the 2020s. So once a year, we get to fill one of our 12 slots every month We used to fill one of our 12 slots with a sale of Apple puts. And I'm sure at the time that we did this, which was back in January 2016, we sold these guys for $12.92. So it was the same kind of logic back then. We sold 5, and it's like, why wouldn't we sell 5? Of course, I want to own 500 shares of Apple in my portfolio. That'd be like $50,000. You know, of course, why not? Because if I own Apple, I can still sell. This is another point I was trying to make today. We were talking about in chat. If I get Apple assigned to me at $100 and I end up with $50,000 worth of Apple at $100, what's the first thing I'm going to do? I'm going to turn around. Now Apple's at like 100, maybe it's at 90, whatever. I'm going to sell the 2019 $100 calls. Well, let's assume they're priced like the 120 calls are, okay? Because obviously Apple would be lower, so the $100 calls wouldn't be as much. So let's assume that the $100 calls are priced like the 120 calls. They're $16. Then I would sell, and now we look at then we would have to look, wait, I was thinking. Then we figure that will collect probably the same concept. We collect maybe $15 for selling the puts, for selling like $90 puts. So now we've knocked off 16 plus 14, let's say $30. So my $100, so in other words, I'm assigned Apple at $100, and I right away sell more puts and calls on Apple, and I knock $30 off my net. So when I'm saying I'm agreeing to buy Apple for $100, I'm really agreeing to buy it for $70, because if I do get assigned it at $100, and again, don't forget, I really want to own it. I can afford to own it. It doesn't bother me to own it. I enjoy owning it. But if I do get assigned my Apples at $100, I immediately turn around and sell $30,000 worth of puts and calls. Or, I'm sorry, $30, whatever, 30 times 500. So I immediately sell the puts and calls. I knock 30% off my assignment price immediately. And then that's 2 years out. So then 2 years after that, I knock another 30% off, and 2 years after that, I knock another 30% off. I all of a sudden have no basis in Apple. I paid nothing for it within 10 years. And I have free Apple stock. Whatever Apple's price is, it's mine for free. Why would I not want that? Why am I not? I want to be assigned these things. I want the prices to go down so we can own stuff. Okay, I don't want to just collect $5,000 a month in my portfolio, my $1 million portfolio. It's a placeholder to keep selling these puts. These are all stocks we'd love to own if they get cheap. And these are the prices we agreed to pay for each of these stocks. This price, less whatever we sold the puts for, is our net entry. But that's not where it ends. And who was it who just said that to me in chat? We just had this conversation. We got to talk about that. I'm on TV later. You can see what's going to be said on TV at 7 o'clock. So this is like market moving information for later. Let's see. Damn it. Who was I talking about this with? Jeff. G.E. Maya. Oh, wait, maybe it was actually here. All right, it was the Shearer with Ericsson. So let's see where he asked that question. Oh, Ericsson's a tough thing to look up because when you do it, it does that. Okay, so now the Shearer, he sold the April 17 $7 puts for 86 cents. And he says, based on the comment, we had a conversation here. I was talking to Scott at the time, and Scott was asking about Ericsson. And I said, if I was going to do it, I would do a conservative play because I didn't think it was worth the risk at 7. I want to see what would happen. So, and as I'm saying, see, I want to be very clear about that. To start a trade, this is what I'm talking about. To initiate a trade, I would just sell. It was at, well, when did we say this? Our idea was, 9, I don't know if you can see that. This is 9.9. So this is in September 9th, over here, at $7. So it was around $7. I still didn't trust it as being a bottom. So I'm saying to start a trade, I would sell the $7 puts for 80 cents. So if we sell the $7 puts for 80 cents, and he apparently got it for like 86 or something like that, that nets you in for 620. So it's a nice 10% discount. Turns out they dropped 20%. But it was a good 10% discount. That's good. Because if he paid full price and he bought a bull call spread along with that, the bull call spread would be hurting and the puts would be hurting, right? So this way, or if he bought the stock, he wouldn't have been able to cover the 20% drop and he'd be down also. So it's not magic. It doesn't stop you from losing money, but you lose less money than you would have. So conceptually now, if he does get assigned at net 620, what happens? So I get assigned Ericsson at net 620, and let's assume it's at this price that it is now. Okay, it doesn't change the fact that I paid 620, right? But am I upset about it? Not really, because here's Ericsson, and I can turn right around and get 90 cents for these $5 calls. So in other words, I own it for 620. I sell the $5 calls for 90 cents. That drops my net to 5.30. Now, if I get called away at 5, I'm going to lose 30 cents. But that's not static. It's never static. That's what you always have to think. It's only the next move. So in other words, if Ericsson does go up, there's several things I can do. One of which I could do right away, one of which is sell these $5 puts for 40 cents, and that would drop my net to 490. But again, as I said, you don't really need to do that, though. If I just wanted to cover it to make sure I don't lose more money, I sell the $5 calls for 90 cents and I wait. If Ericsson starts going up and it looks solid, I can then sell the $6 calls for let's say they go down a bit to 70 cents, 60 cents. And again, even if Ericsson's going up, I can still drop my 520 basis, or 530. I can still drop my 530 basis another 60 cents just by selling the puts at that point. There's always a move and then another move and another move you can make. You have to think of it in terms of like a chess game. It's like you want to just wear down the basis over time by making different moves. How can I do something intelligent that will lower the cost basis of this position? And if you keep doing that and you focus yourself on that, don't forget this is only 6 months away. It's 191 days. So if you focus on that, and if every 6 months you're able to knock 10% off the cost basis of your position, that means you're 5 years away from free stock, at the worst. So unless your company is going actually bankrupt, or unless it's dropping more than 20% every year, which will be hard for you to keep up with, you are going to be able to essentially have free stock there. Now, if you do that with dividend stocks, so what do I mean by free stocks? It means that within 5 years you've recovered all your cash. So if you have $100,000 now, at the end of 5 years, even assuming you make no money on any of your stocks, you get your $100,000 back and you have $100,000 worth of stocks. Now, if all of your picks were horrible and they don't recover, then after 5 years you'll be even. But if over time you collect dividends and those stocks recover, now you've got $100,000 worth of stock and $100,000 in cash to start buying more stock. And while you're buying more stock, you're generating more money with your $100,000 worth of stock by selling more puts, more calls, and collecting more dividends. And I want to be clear about this. I'm talking about doubling your money every 5 years, unless you are the worst picker of stocks ever. Unless the market is in a horrific downward spiral that doesn't recover from, you can double your money every 5 years. And you do it with simple, conservative plays on blue chip stocks. That's what we do in our long-term portfolio. Now, it doesn't stop things from going well, because we've only been running the long-term portfolio for 3 years. Is it 3 years? It's almost our anniversary. 11/26/2013. And in 3 years, we're up 121%. And that's not even counting the short-term portfolio, because the short-term portfolio, which is paired with the long-term portfolio, is up 373%. So it's up another $400,000 or something like that. 375 to $374,000. So this one made money, and the long-term portfolio made money. We started out with a total of $600,000, and now we've got 1.1 plus 4 is 1.5, $1.6 million. So we've made actually $1 million in 3 years. That's 150% basically between the two portfolios. So if things go your way, you can do much, much better. But I'm saying even if things don't go your way, even if things are terrible, even if the market is flat or down or blah, you can still double your money. And if you can double your money when the economy is bad, you will probably be able to buy some really cool stuff with your $200,000 in 5 years. The problem is that a person starting out with $100,000 wants to get $1 million, and they can't see how they're going to get $1 million unless they gamble their asses off. And that's what I really want people to learn not to do. That is why, by the way, we are running these long-term portfolios. What I kept doing is whenever they doubled, I would shut them down. And so we kept shutting them down, shutting them down, shutting them down. And the problem with that is nobody was learning the lessons. So I want this long-term portfolio to just get to some ridiculous number, because I want to show someone what happens when I want to show people what happens when you stick with it for 10 years. You stick with that thing for 10 years, and you can end up going from $500,000 to $5 million if it goes well. It compounds because they're solid positions that, just the dividends alone. I think we talked about that a week or so ago. But in the long-term portfolio, you get to the point where just the dividends are paying you a nice income. Oh, I remember what it was. It was like $50,000. We're collecting $50,000 in dividends. Don't forget, we started with $500,000. So now we're collecting 10% of what we started with in dividends, and that's like almost rock solid. I mean, these are generally good companies. They're almost rock solid. We're going to double that in the next 3 years, and we'll be collecting $100,000 a year in dividends. Then we'll double it again. So by 10 years, we'll be collecting $200,000 a year. That's 40% of what we started with every year, just the dividend payments. That's how you build a portfolio. I don't have to do anything. I don't care if the stock appreciates or doesn't appreciate as long as it pays me my dividend. And there's another thing, because as these positions mature and we end up owning some of the stock or whatever, you work your basis down to the point where you don't care anymore and you're just selling the calls. You don't have to, you're not selling puts and calls. When you work your basis down low enough and you own some stock, or you have very low level, or your calls are very deeply in the money. We don't have too many of those, but we do have some. Then you don't even bother selling puts anymore. You just keep selling calls. Like, look, we own ABX. We have ABX $12 calls. We have BHI $30 calls. Look how they're. I mean, they're half of them. They're $22 above $30. So these guys will expire eventually, or we'll roll. We're going to roll them and so on and so forth. So it's not obvious that we've whittled down the basis, but we're going to take the profit. We're going to if we re-up it in BHI, we move it somewhere else. The bottom line is we have a very low cost. We didn't pay anything for this money, and we're putting it right back to use and rolling it in. That's how we do it. We're going to liquidate $10 calls there at $19. These are crazy things. That's what happens if we work our system. But the funny thing is, and you guys have seen it. The market's gone down. We had a little crash in a couple of times, but we stick with it. And in fact, like this guy, we were just talking about this with Sears, because we were talking about buying Sears. It wasn't yesterday, it was today. So Bruce Berkowitz here at Fairholme, he was, it's a video, so I'm not going to play it, but he was talking about Sears and the value of Sears, which he basically said exactly what I said when we just picked Sears for one of our back for a new trade, which was what, yesterday? I don't remember anymore. It wasn't yesterday. Yeah, it was Tuesday. Yeah. But he's a value investor, and he sees Sears as a value play. And he said the exact right thing when he said about Sears. He said everybody's freaking out because they burn a lot of cash. But I'm not. He goes, but I don't look at the cash because he says at some point I can stop the operation. Oh, wasn't it? I thought it was here. I'm very confused. All right. But so he says about Sears, he says at some point, this is Sears. What are we talking about? So yesterday, right into the close, I looked at Sears. I was in the process of looking at stocks that I thought were cheap. And Sears just keeps coming up for me. And I said, look, I was even, like, while I was writing this, I'm thinking about it, because I'm like, because you look at this balance sheet, and you look at where they are, and it's exactly what Bruce is saying. Like, he's saying, like, look, you look at the balance sheet, and it's scary because they got a lot of debt. Got $13 billion in debt, and they've whittled down their equity. Their cash is not exciting, $238 million in cash. So they have to raise cash, and running the operation is costing them $1 billion a year or so. But he's saying, look, that's not the way you got to look at it. And this is how I look at it, because I used to be an M&A consultant. I'm looking at it as a bankruptcy. I'm looking at it as if a company's engaged me and said, would you, we're thinking of buying this store out of bankruptcy. Is it worth it? So I look at it and say, okay, you got 3,000 locations. You've got really good stores. I mean, if you think about Sears, think about where Sears is in your town. It's the anchor for the mall, or if you're one of those towns that has a standalone Sears, like Hackensack, New Jersey, I know has a standalone Sears. It's right in the middle of town, right? Because the town, 100 years ago, they built the town around the Sears. You can't get a better location because that was the center of town, basically. And if it was a mall, most likely they built the mall around Sears too. That's how it was. So you have all these fantastic, so when you say, we have 3,000 locations, it's not 3,000 random pieces of land. It's 3,000 incredibly great pieces of land that have perfectly good stores on them, functioning retail stores on them. Now, not a lot of people want to buy big, giant department stores, so you've got to look at it that way. It would have to be broken up and turned into tenants and whatever. So it's really, mostly you're looking at the value of the land. Then you have to think, but even that, it's like a couple of million here, a couple of million there. You're talking about billions and billions of dollars worth of land. Then they've got their brands. They've got Kenmore. They've got Die Hard. They've got Craftsman Tools. So you're like a billion for the brand name. Then you've got the Sears name and the whole that's worth like $1 billion or more. To anybody who wants to pick it up and be some kind of work catalogs or something like that. So they have all that, plus they do have assets, they do have inventory, so on and so forth. So I understand, yes, it's costing them $1 billion a year to stay open, but you know what? If they close and liquidate, they've got billions. Even after they pay off their debt, they'll have billions of dollars, and billions of dollars is a lot more than the $1 billion the company is being valued at right now. So, pending a plan, which has not become evident yet, but pending a plan to reorganize or sell off the assets, which they are starting to with the store. They've been whittling down the stores slowly but surely. But pending a plan to sell off the assets, they could suddenly pop, and people's attitudes about them could change drastically. So the play we made was just simply, at the moment, just to keep a tab on it, because they have earnings in, I forget when the earnings are. Didn't I not write this down? I forgot. All right, hang on. It's an important piece of information. I believe they're in November or late October. Oh, December. That's right. First week of December. So earnings, first week of December. So I need a time frame that takes us past the first week of December. Depending on what they say at earnings, they may excite people right then. People they may sell off something between now and then that's going to get people excited. So I wanted something that captured that time frame. So we went out to January, we picked up the $12 calls for $1.20, and we're going to, if they go below 60, we're going to get out. We haven't even got in yet. We can't fill this trade so far because nobody's giving it to us for $1.20. And we'll see what happens. It's a gamble. This is a gamble trade. I want you to be very clear about that. But we like it because there's a tremendous upside. So I'm saying if we get back to $4, we can get back to 16 on Sears. Where's the thing? If we get back to 16, we're going to be up $4 from our $12 calls. We're going to get $4 back, and that's a 300% gain credit, or 233% gain. So upside 233%, downside 50%. I'm willing to gamble that, which we're gambling $3,000 to see how that goes in the short-term portfolio. It's risky, but that's what we do in the short-term portfolio. We take risky bets. And you know what? That's why the short-term portfolio is up 300%, because we take risky bets. You know, and enough of them pay off. But, by the way, we take risky bets. Like, I think there's a 25-30% chance that Sears pops in that time frame. But my upside, like I said, is 233% versus the 50% downside. So the upside is 4 or 5 times higher than the downside. So I believe the odds of it happening, I believe the odds of that happening are better than 1/5. So it's a risk I'm willing to take. And that's what risk reward's all about. So in other words, if there's 8 horses, and you think your horse is going, well, let's say it's 10 horses. There's 10 horses, your horse has a 10% chance, and there's other factors, right, that come into play. It's not random. There's certain factors. If you know enough factors and you have a reason to believe your horse has a 20% chance of winning, now that means 1 in 5. So you should get paid 5 to 1 for betting on that horse. Now, if the odds of your horse are 50 to 1, but you think it has a 20% chance of winning, you should make that bet. If it's a favorite, on the other hand, if it's a favorite and they're paying you even money, which I never understand why anybody would even make those bets, but if it's a favorite and they're paying you even money, they're saying it has a 100% chance of winning. And I don't care how sure you are, why would you make that bet? I never understand people who make those bets at the track when they get back like $1.20 for $1 bet. I'm like, well, what are you doing? I'm like, 20%. It's ridiculous. There's 6 other horses, 8 other horses, and you're going to make 20% of your horse win? There's other competition. Anything could happen. But that's the point, though. With options, we take the opposite side of that bet. We sell to those guys, because you know how those guys, they put too much money on their horses. Can't believe it lost. It has everything going for it. Like, no, that's why you bet against it. Because the odds you get for betting against it are much better than the odds you get on betting for it. It's not about whether we have that opinion or not. You have to look at the statistics. All right, so, May says, can you please look at Apple? I didn't quite understand your 3 Phil World posts this week. Where do you suppose good support is for Apple? Apple. Okay. Apple. Oh, how convenient. All right. Look at that. So we're grinding up, and Apple's like doing a little grind up. It's really having trouble just popping it. Not a second. Let's see how the overalls. Okay, nothing happened. So, it's just basically, it's doing this little dance. It's moving up. Now, when you say support, obviously support's going to be this 50-day moving average of 110, which is creeping up to, whatever. But, it's not likely to fly back down to there, so the support's probably going to be about 112.50. See how there's good support on this line here? And if you look closer, well, you can't, that's daily. You can't look at that. So 112.50 has held up since mid-September, middle of September. So we've got a month now of proving out 112.50, and the 50-day moving average is racing up to 112.50. It's going to catch it. Now, here's a good pop quiz. If Apple is going to hold 112.50 for another 30 days at least, where's this line going to go? Well, this is the 200-day moving average, and 112 is 10% higher than the 200-day moving average. So it's going to move up at least 1 point. It's going to move. It's going to move over 10% of the time. It's going to move up 10% of the position, which is 1 point. That's how slow the 200-day moving average is. Now, if Apple is at 120, though, in the same period of time, this will move up 2 points. Now, if this moves up 2 points, though, it's going to look pretty sharp, right? Because it's going to go from 101 something to 103 something. When's the last time it was at 103? It's up here. So imagine if this thing in 30 days goes up to here. That's going to look pretty dramatic, right? And at the same time, the 50-day moving average in 30 days, if Apple stays up here, will cover half of that ground at least, and that's going to look dramatic too. So Apple could become extremely dramatically bullish if this starts curving up and that starts curving up. So if we do get over 120 and 120 holds, you are going to see a lot of people, for technical reasons, piling into the Apple trade. That is how you use a chart, by the way. You don't use a chart to look at the past. You look at a chart to think about the future. If my stock does this, what will happen to the lines? Because the lines are what all the PA sheet follow after the fact. You can simply think about how the lines get drawn, and you'll know what's going to happen before the fact. And believe me, knowing things before they happen is much more profitable than knowing things after they happen. Before earnings announcement, did you go long at 105? What? Apple's not at 105. I don't understand the concept. Control plus makes it larger. Really, this thing? But does that make all my stuff larger? Control plus. Yeah, oh yeah, the same thing as this thing. Okay, well that's good, except then it makes all the other pages incredibly ugly. Well, it hasn't yet, but unless maybe it's just for this page. Then I guess control minus minus. All right, that's good, thanks. I will try to remember that one. So anyway, as to Apple, would you go long? I'm not sure about that question. It's like Apple is higher than 105. So would we buy the 105? Would we sell the 105 puts? Yes. It's like, but I already put up like a whole bunch of plays for Apple, so I'm not sure what the real question is there. But yeah, we like it. I think it's going higher, but you also got to watch the market. I think the market's weak and possibly going down. And if Apple does come down to 105, I guess maybe that's your question. If Apple comes back down, yes. Here's your 200-day moving average. I can't imagine Apple's going to drop that far to hit the 200-day moving average, even if the market drags it down. But if Apple's down under 110 or in this area, I would expect this line to hold. And I'm bullish. I'm bullish now. I'm bullish now, but I am aware of the fact that it could correct first before it goes higher. That's why we went with long-term plays. We're not making short-term plays. We're making 2018 trades. Phil on Shield, you cannot buy a $17, $12 call for 120. No, you can't right now. Unfortunately, it went up real fast as soon as I made the trade. I think people bid it up. And obviously, there probably wasn't that many people trying to sell it for that price. That actually it actually makes me want it more, though, when I know that people won't give us a break on the price. But I don't want to pay more. Oh, in fact, the bids went to 125 now, so somebody started bidding more. Now, so here's the question. If we look into March, how much are those $12 calls? Those are 160 something. So is it worth 40 more cents to be in March? Yeah, I don't know if I feel that way about it. Now, you could go for a spread. You could pick up the March 11 and sell the 15s. 15s are, well, then it's not 91, I don't know if it's 95, but you can get like 80 at least, or let's say 85 for the 15s. So if you buy these for $2 and you sell these for 85, you're only paying 115 for the 11s, basically. That's not terrible. But the thing about being in the spread is I don't want to be stuck in Sears. I want to take advantage of a pop and get out. And with a spread, you're kind of stuck. So my answer is on that, I would just continue to offer 120 and hope they sell down a bit more. I mean, look, the market is going to drop more. And it will probably drag Sears lower. So why would I pay more? I'm not going to chase it. I'm going to wait until it hits my price. I mean, frankly, look at this one though. You can sell the $8 puts. I wish I believed in them more, because you could sell the $8 puts for $1. As it sounds great, but they could screw up and go lower. So I really only want to buy the calls, and I only want to buy them if they hit our price. So yes, well, look, SPX will drop. That's why I was talking about a hedge today on DXD. That's important too. Boy, I say a lot of important things. All right. No wonder I'm tired. It's like I didn't get a break today. Usually I take, you know what it is? Usually I take a break. I eat something when I take a break, and I haven't eaten today, so I'm like, yeah, I've just been working straight through without ever getting up. DXD, okay. So DXD is an ultra ETF. It moves twice as much as the Dow. So if the Dow drops 10%, this will go up 20%. 20% of 17 is 340. So it'll be a 2040 round, which is higher than it's been at all. So it would really, if the Dow drops 10%, it will really fly. So the trader we looked at this morning for DXD is buying the January 16s for $1.40. 16 is lower than it is now. That's way down here. For $1.40. And even that, though, why should we pay the premium? So we sell the 20s, because we don't think it's going to go over 20. We sell the 20. If I don't think it's going to go over 20, why wouldn't I sell it? We sell the 20s for 30 cents. That nets us in for 110. And if it goes back to 20, you make 263% just off the spread. Now, if you want to go to add something, I talked about like lumber liquidators. Pick a stock you really would like to own if it goes lower, like lumber liquidators. You can sell the 17 puts of January, which is very short-term for a put sale. Sell the 17 puts for $1.40. That brings in this case, another $1,100, so we sold half as many. And now you're net $1,100 on I think, $12,000 worth of protection here. That's the way you hedge. So, yeah, you don't, I mean, look, if the market will go down. It's not a question of things. You should never have that attitude. It's like, I hope the market doesn't go down. Okay? If you have a lot of bullish positions that make money when the market goes up, you are obligated to take some of that money and hedge. It's insurance, okay? It's like not having life insurance. It's like going, oh, well, I hope I don't die. If I do die, well, everybody's screwed. My wife is screwed, the kids are screwed, the house won't be paid for. You know, you can't go through life that way. Okay, hope is not a strategy, okay? You need to protect your portfolio. And you can't have just bullish money sitting around in a portfolio and just your big plan is that the market hopefully doesn't drop. Ooh, 2 minutes to the Fed. Thanks, Brian. That was important. All right, let's see what's going on here. How do I add him here? Bookmark this page. Yes, that's what I want to do. All right, so back to the Fed. FOMC. Going to need my television. All right. And we need our Wall Street Journal so we can see what they write. Great. What time is it? 1:57. 3 minutes. So we are waiting for this. So for the September 21st meeting, they're going to add the minutes, and then we're going to look at them and see what they say. But the minutes are a lot of BS, and really the market's going to react way before we get a chance to read them out. So we're going to, first of all, just watch what happens. So here's our indexes. They are currently flattish in anticipation of something happening. All right, and like I said, the way the Fed speakers are set up, it seems to me that this is going to be, of all things, a bullish event. It's very odd, but apparently the Fed is not worried about the market's reaction to these minutes, or they wouldn't have run their speaker schedule the way they did. The weird thing is, I think generally what they're talking about is people's expectations are about 60% that the Fed will hike in December. I don't think the Fed could have possibly been any clearer about the fact that they're going to hike in December. So then the question is, what happens to the other 40% when they have to adjust their strategies based on the fact that rates are going up faster than they thought? It won't be good for REITs. It won't be good for TLT. It won't be, for bonds. It won't be good for the market in general. I just think that people are going to start having a different expectation. And when earnings come out, people are going to start looking very closely at all this corporate debt that's piled up. So it's weird. I'm a little confused as to why they're doing it like this. It seems odd to me. We'll find out in about 60 seconds and see what happens. Oil's holding the $50 line pretty good. Dollar's still way up here at 19. The dollar's expecting something hawkish from the Fed, basically. It's up. Up, here it is. Oh, for God's sake. The minutes pretty much say they're all on the fence. I hate this because they already read it. They have this stuff way ahead of me. And if they have it, if the news people have it ahead of you, you guarantee it that there's investors that have it too. All right, well, we are, as we expected, we're getting a bit of a bullish reaction to it. Now we'll see if it's justified. All right, but nothing exciting, so we're just going to take a good read and see what happens, okay? So let me refresh this page. They don't know what's going on, basically. Revisions. Ugh. Where? Oh, God. Seriously? What? Ugh. I would shoot myself if I was on this committee. Committee briefs on plan revisions. All right. They generally continue to trade close to the fund's target rate. Unanimous vote. They ratified. That's not the thing. Staff review of economic situation. GDP was increasing at a faster rate in the third quarter than the first half of the year. Price inflation continued to run below the objective of 2%, restrained by decreases in energy prices. This is where it's really important. They see GDP picking up. They see the consumer price inflation is running below. But why? Because of energy prices. So, what has happened since this meeting to energy prices? Serious. I don't even know how to use this thing anymore. There we go. So since that meeting, oil's up $7, 15+%. That means that a key reason that they're not raising rates has completely gone away since the meeting. So inflation expectations a little changed. They're not changed now. They're not changed now. They're certainly changed now because we get a 15% increase and it takes not very long for that to start flowing into the rest of their data. Non-farm payroll, we know about that. Unemployment ticked up, so that got a little bit worse, but not much. Initial claims. So their main thing is inflation and jobs. That's what they're looking at. Compensation for the business sector was 2% ending. Now, the 2% compensation, that actually went down since the last meeting. We had a very poor, I think it went down to 1% in the last report. So that's another reason that they can tighten, because that's also what they consider labor cost to be inflation. So the labor cost is low, and they want to keep it low. They don't want it going up. So when they're looking at 2%, 2.5% increases, they want it to be down. You've got a poor report, so that takes a little pressure off them tightening, but the oil puts pressure on them to tighten. And by the way, especially oil, because what's the number one reason people start asking for raises? It's something happens that makes them have to afford it. So when healthcare goes up, people ask for raises. When if they're paying for it, when if the cost of getting to work starts exceeding the benefit of working, people ask for raises. If you're a boss, how many times have you heard that? Somebody goes, "Yeah, it cost me $25 just to get here." So that's a great reason to give someone that people ask for raises. They're like, hey, it costs me more money to get here, especially all the New York companies where they keep raising the damn bridge prices. And they're like, well, move to New York. I'm like, you can't afford to move to New York either. It's crazy. $15 for the bridge to go to New York. So if you work in New York, $15, it's discounted a bit when you have a pass, but not much. It's like $15 every day into the city. So 5 days a week, $75 just to pay the toll. And that's if you pay one toll. If you're in Jersey, you go the Parkway tolls too. It is crazy around here paying for stuff. And now they're jacking up our gas taxes by 23 cents a gallon, which I'm very much in favor of, but just keep hitting the consumers, unfortunately. Industrial production rose slightly. Output of mining increased, blah, 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 nothing exciting. Real personal expenditures appear to be increasing solidly. See, that's good, but that's inflation driver. PC rose strongly in July. Consumer, what you need to do is read this and think about, look at all the things the Fed looks at. The Michigan Consumer Sentiment Survey they're worrying about. And it remained upbeat, and it has still remained upbeat despite everything else going on. Despite having to look at these candidates who are running for office. Housing activity, resident spending is soft, that's been true. Single-family homes are declining, that's fine, it's just a blip. Building permits, don't care. What about commercial? Real private spending, here you go. Business expenditures rising slowly, shipments of non-defense capital goods decline, so durables are declining. However, new orders for capital goods were substantially up, so that remains to be seen. Firms not spending for non-defense structures. See, they're just reading the same frickin' reports we are. They really are. They're just reading the same GDP, durable goods, Michigan sentiment. All they're doing is reading what we're reading and making a decision. Outlays for defense, but it's important to see how their thought process is as far as what they do. Total prices increased about 0.75% over 12 months ending July, partly restrained by a decrease in consumer food prices. That's turning around, and energy prices. That's turning around. So the two main factors they're looking at in prices are turning around. They know they got to put a lid on that. This very much points to a fourth quarter thing. The market should not be going up on this information. Over the last 12 months, CPI is around 2.25%. Michigan survey, long-run expectation edged down was unchanged, but that's going to change it because of the oil and the measure of long-run inflation expectations. Now, oil, of course, I'm predicting oil is going to go back down, but then it'll start going up again anyway. The net of oil is going to be higher from now on. Just it's going to finally, we're expecting one more blip down, and then from then on, we're bullish on oil. Foreign real GDP growth slowed noticeably in the second quarter. Contractions, the outcome of the UK. They're worried about Brexit. Wow. Really? Financial situation. Financial conditions accommodative, blah, blah, blah. Federal officials were interrupted by market participants raising odds on policy firming by the end of this year. Wait. Interpreted, not interrupted. However, domestic economic releases appear to be little or softer on balance. Oh, yeah, I can do that plus thing. Aha! Broad stocks moved down on that. They're watching the market. This is ridiculous. This is not normal. Having read many years of Fed reports, this is like crazy what they're looking at all this stuff. Financing conditions for non-farms, gross issuance of bonds was strong. Of course, bonds are strong. Nobody knows what to do with their money. Financing conditions for households accommodative. Global risk asset prices increased. Foreign central banks, staff outlook economics. Okay, here. What do they think is happening? Little change from July, the real GDP growth, which is the same thing. Staff continue to predict that real GDP would be modestly faster, supported primary increases. The unemployment rate was forecast to remain flat because we're at full employment. The forecast for consumer prices is unchanged. And the staff viewed the uncertainty around projections of GDP similar to average. So they think that they're pretty on target. They don't see any reason to worry. Everything here says raise. All right, so that's enough of that. And now we'll see what the Wall Street Journal has said. Minutes may leave investors wanting more, blah, blah, blah. Why banking? That's what you're up to? Come on, it must be an updated article. Wow, they have not put up a thing yet on this. It's terrible. All right, we'll come back to it later. But anyway, so I don't think there's anything here to be bullish about. And how does the market look about it? So we're back to those same levels, though. We're back to these weak bounce levels. And we're going to have to see. But I think probably, see these pink lines? I think we're going to get rejected of these pink lines. And if we do, who's going to be the best one to short? I think the Dow could be good for a drop back to 18. So if we pick the Dow down at 18, let's say we want to short the Dow at 18.1. So we'll go to the active screen. We have the Russell, the S&P, we have coffee, which is going up again. I want coffee to come down so we can buy some more. YM for the Dow. Oil, we're not going to worry about. So, oh, damn it. And put the NASDAQ up to NQ. All right, so we think that everyone will get rejected off these pink lines, and we have so far. And I'd like the Dow to be a little bit higher before I play it, unfortunately. I'm not too psyched about giving up 15 points. I'd like to be over 95. Over 95, I don't mind making an entry. And this happens in the futures, by the way. I mean, if you miss it, you miss it. Don't chase things. Wait for the next clear things to cross. Because even if you're a genius, you're at best going to be 60%. So if you start chasing things and you're wrong, then you're overpaying and you're wrong, and you get burned much harder. Now, these things are struggling terribly. So apparently there's plenty of people who did not like what was in the futures. And we'll zoom on this a little bit. I can figure out which way is plus. So I think I'm being realistic. I need it to be 95. It's at 86. And what I want to look at is these last couple of candles here and see how realistic that is. And looking at the S&P is 37, 37.25. I want to see these things move. Now, on the other hand, if I see everybody moving up, then I might not be so excited about buying it even at 95. I have to then think about what my term. That's the other thing, though. You have to look at that. That's not only am I waiting, but I'm waiting and I'm getting more information. So if everybody starts getting warm to these indexes, but I think we're going to get rejected here. We're at 90 up, see 92 and stopped. So I think what I'm going to do is I'm going to take a 95 with it. Ooh, wait. All right. Ow! Missed it. Hesitated. Oh, no, don't do that to me. That's so unfair. I still won't do 93. I'm not doing it. 94 maybe. All right. Oh, yes, there it goes. Bing. See? You are rewarded for waiting. I would have been rewarded if I waited for 95. So now I have one at 94. The next thing I want to look at, then I want to average 00. I want to average 18.1. So that means if I'm 6 down here, when I'm 6 up, if I add another one, I'll get my average to 1800 or 18,100. But look, see? He's right at the line. I don't want him going any higher, so I'm probably not going to get a chance to double down. In other words, by the time I get to double down, I want to stop out because he pops over his pink line. So double down is probably not in the cards here. And you always have to be thinking about the repercussions. Like, if the only way that I'm going to be doubling down here is if this goes up past the pink, or up to the pink line, a little past it, and that means as he's close to the pink line, I don't want him to go over the pink line because that indicates everybody's being bullish. I want him to be rejected at the pink line so my theory holds up. And it's hard to say exactly where that pink line is. That's the problem. Well, it's 213825. I did say it for a second. It's hard to, when this thing sort of wipes it out when it's going there. So 3825 is the pink line, I think. You really won't know until it moves completely away from it. See, like this guy says 48, he's got a label, but the other guys don't. Because once the active box comes close, it wipes away the pink line's label. It's really annoying. Possibly if you zoom in. Let me see if I zoom in if I can get 2. Nope. Nope. So you just have to eyeball it. And I'll say it's 3850 for, let's say. So if the S&P pops over 3850, I'll have to stop out of this guy. But my interpretation of those Fed minutes was fairly bearish, and therefore I'm looking for a bearish bet I can make. And if I find one, I find one. But again, like I said, if you don't find one, if you don't find a good level to get in at, don't do it. So I could be wrong. And frankly, usually what happens after these Fed minutes is the market goes up, no matter what they say. Because they're usually just looking for an excuse to go up. And today's a holiday. It's a Jewish holiday. It's got low trading volumes. It's very easy to push things up for no reason. Oh, here we are, right at 3850, 97, 99. 18.1, 38.75, 18.2, 18.4. Didn't hit my 18.6. Damn it. I'm kind of torn. I really want to average in an 18.1, but on the other hand, like I said, now everybody seems to be perking up. So, So I want to read more is what I want to do to find out what it says. Okay, here you go. Fed minutes show officials expect to raise rates relatively soon. This is important because what the Wall Street Journal says becomes a sentiment that then goes across. Short-term interest rates relatively soon. They have struggled to reconcile the division over the timing. Some participants believe it would be appropriate to raise the target for the federal funds rate relatively soon if the market continues to improve, while others prefer to wait for better evidence. But we are. Evidence that inflation was moving towards the objective. That's what oil is accomplishing right now. Fed held off on raising rates, even though it said the case for higher costs had strengthened. In a summary, the Fed officials released following: Fed raised rates in December and kept them near zero. The minutes of meeting decision was a close call. See? Fed had 2 more meetings left this year, November and December. Investors expect the rate move will come in December. It was noted that a reasonable argument could be made either for an increase at this meeting or waiting for additional information. Data, an upbeat picture of the U.S. economy in September. Consumer confidence is good. So, we just read all this. There are also reasons for concern. So they're worried about the Brexit. The dollar did increase. That already happened. U.S. economic growth keeps getting downgraded. That's true. That's continuing. The minutes show the Fed officials didn't see major threats to the. Why are they looking at the IMF's growth rate? Don't you think the Fed should know more about our economic growth than the IMF? Can you imagine the Fed is looking to the IMF to tell them how much our GDP is going to be? That's scary. Still, the minutes officials didn't see major threats to the U.S. economy. I don't see it either. Majorities of the U.S. stood around, even chance of performing better, blah, blah, blah. Okay, so basically I think unless Deutsche Bank blows up, or some other one, probably, most likely Deutsche Bank, but unless Deutsche Bank actually blows up in the next month or so, then they're going to have to raise rates in December. That's my theory. All right, so back to see where it's going. Little annoying because it's not staying down though. I just don't see any reason not to stay with that trade. All right, let's catch up. Why DXD, Apple strength, Samsung might hold up? Okay, because Apple's not going up that significantly, I don't think, from 120. Also, because we talked about Chevron. In fact, they wrote that in the article. If oil starts going down, then Chevron and Exxon are going to suffer. Also, Chevron has a gigantic fine from some ridiculous country is fining Chevron a huge amount of money, and Exxon's got some problems also. So there's a lot of issues with both those companies. They probably would drop off a bit in the near future, and they're big Dow components as well. They'll more than cancel Apple out if they start falling. And also, Alcoa had crappy earnings. They just released them yesterday. So again, now you have to question all the Dow components. How will they start doing as they report earnings? So I think I might get more bang for my buck out of the Dow. Are they still worried about the mortgage market? I don't think they are. They said that it was still tight. It was still kind of hard to get a loan, which is true because if you think about how many people's credits got destroyed, there's 2 things about mortgage loans. Especially mortgage loans. A lot of people defaulted on loans and had problems, or even not even defaulted. People missed payments. When you're unemployed, like 20, 30 million people were, probably at least 10% of the homeowners in this country. And when you're unemployed for 6 months, you get behind on your rent, you're behind on a bill, this and that. So your credit score goes down. Problem number 1. Problem number 2. People don't have the equity built up in their homes anymore because the homes people were underwater, homes didn't appreciate, so on and so forth. The people who got foreclosed on, people who walked away from their homes, they got bad credit scores too. The people have less equity in their home, so they can't just sell the house they're in and get another one. They have to stay where they are. That drives down the amount of people, and obviously having a lower down payment makes you less qualified to get another mortgage. So there's a lot of problems as far as people getting mortgage loans, and those credit scores impact other kinds of consumer loans as well. So, the banks are happy to lend you money if you have a great credit score, but they don't stop sending stuff to me. I know that much. But for regular people, they can't even get the credit that they want if they want it. It's really messed up. Oh, and the dollar's going down? That's worrying, because if the dollar's going down and covering a sell-off, then you've got to be very concerned. So let's see what the dollar looks like right now. Yeah, that's not much. No, I said this morning, if they hold 97.50, which is now the pink line here, if they hold 97.50 on a pullback, they're very likely just consolidating for a move up. Because this has been a hell of a run for the dollar. I mean, of course it's going to pull back. And again, you go back to, it's very simple. You just look at the 5% rule and say, here's what it's going to do, just like we did with the indexes. Okay, we went up from, well, see if it's a broader consolidation. All right, if we call it 95 to 98, that's a 3-point move, right, from 95 to 98. So what's that pullback going to be? It's a 3-point move up. 20% of 3 is 0.6. So basically 97.40 is a weak retracement. We're not even close to that yet. And if it pulls back strongly, that'll be $1.20, or I'm sorry, 0.20. So then 96.80 over here is a strong retracement. So really, anything more than 96.80 is not even a big pullback. Now we'll look at the hourly and see what that looks like. So 96.80 is right about this line here. And what did we say it was? 60 cents, right? So, and 90 right here, 97.10, I'm sorry, 97.40, this line over here would be strong, but I figured 97.50 is actually going to hold. Now, let's say use the 5% rule, okay? It's about you watch the move, which is, now in this case, I wasn't sure if we should use 95.50, and I'm not using 95.50 because if you look at the bigger picture, you can see the consolidation is really at the 95 line. Okay, as we consolidated at 95 for quite a long time, as it got stronger, it made higher lows, but that doesn't mean that you should use a different consolidation line. The line is really 95. But just to double check, if we calculate it from 95 to 98 is 250, and then the only difference then is the retrace is 50 cents and not 60 cents. So that goes back to that 97.50 line. So either way, so always if you calculate it from here, you're going to get 97.40. If you calculate it from here, you're going to get 97.50. So honestly, it doesn't make a difference really. In this particular case, it comes out to the same thing. So that's nothing. If you're not sure where to consolidate, just run the math from both places. And amazingly, you get your answers. See how our indexes are performing? Now, see, they're getting towards the strong bounces, but that's at 18.1. We shorted at the strong bounce line at 18.1. Not exciting, but it's getting somewhere. Oop, shouldn't have done that. $25, not very exciting. But again, it's a timing thing. I mean, I don't expect the thing to make money in 5 minutes. I mean, these are trades that you put on until for some reason you change your mind. And we had decided that we have 2 more hawks going in the next 2 days. I don't really see any reason for the market to get more cheery. So I am looking for a drop back to 1,800. And if I get that drop, it's going to make $500 on this silly little thing here. So that's my goal. And oil is not very exciting right now. Oil's at 50.29. We short when it gets to 51. We'll short it again, and we'll keep a tighter stop on it if it goes. See, because it goes all the way back to 51, it's more likely to break over, right? When it was hovering around the 51 line, it's less likely to make a big move. If it's going to 51, it's already made a big move. And so if it goes anything over 51, you've got to be worried. So your logic has to be a little bit of a tighter stop. All right, I got to wrap this up soon because I got to start getting ready. I got to go to New York today. I'm doing that show. I'm going to be on TV at 7 o'clock on Money Talk, which is on BNN TV in Canada. So if you go to bnn.com, I'm pretty sure you can see it. So yeah, the dollar's really retraced, not a dive. All right, and otherwise I think we're in good shape. So, oh yes, what am I going to say on TV? Let's finish with that. We'll talk. Good for me anyway. I need to review what I'm going to say, right? So here's how it works. Here's some inside TV stuff, right? So the producer says, here's what I'm thinking of for today. Segment number 1. I'm on for the whole show. Get your thoughts on anything worthy, read the Fed minutes. Oh, by the way, also important information. TD Bank, TD Ameritrade, they own this show. TD Bank owns BNN, the Canadian Broadcasting Network, the Business News Network in Canada. It's their network. So basically, this is a TD Bank, TD Ameritrade sponsored show. I'm on for the whole half hour. It's a huge thing in Canada. It's like CNBC in Canada, basically. It's like, it's what everybody watches. So your thoughts on what's going on? Anything worthy of the Fed minutes? And so what are we going to say about the Fed minutes? Basically, that I think the biggest thing to say is, look, if oil prices are going to stay up this high, they have no choice but to tighten, and sooner than later. Because that's what they're watching. They're watching inflation. They're saying the inflation has been mitigated by oil. Well, now it's no longer mitigated by oil. It takes away the main reason they haven't tightened yet. All right, Q2. So Q2 is the fourth quarter. Oh, no, wait. Anything playing market slide this week? Oh, what about the market? Oh, I see. She asked me about the market slide, and I said, I'm saying Q2 is the fourth straight quarter of declining profits, and I said, here's a good chart for that. And you can see we have minus 2.6%. So S&P profits on the whole are down 2.6%. Why should the S&P be higher if the profits are 2.6% lower? There's no logic to that. And the Fed's going to tighten. And that's going to raise their cost of servicing debt. On oil, so she's just giving me topics. I'm thinking, okay, if OPEC makes a deal, they aren't, and that's what I wrote about last week, they aren't going to cut production enough to rein in the glut. It's so ridiculous. They're talking about cutting production here. They're 33,750. They're saying they want to cut it to maybe 32.5. So that's 1 million barrels a day off. That's where they failed to cut production last time. So last time, when they said they were going to cut, and they didn't cut over the summer when people were counting on them to, since then they've ramped production up 1 million barrels so that now they can cut it 1 million barrels. So all they did is all they're doing is not cutting from the summer, which they said they wouldn't do in the summer. It's the same failure, except now they're starting from a higher point to make it seem like they're doing something. It's amazing. All right. Also, I said very important. Germany is now looking to pass legislation that all cars are going to be electric or non-petroleum by 2030. And I said, look, the key, and this is a big thing all you guys should understand. Saudi Arabia has 30 years of oil in the ground at the rate they're pumping now. And so do most people. 30 years of oil at the rate they're pumping now. But automobiles, if Germany is doing it, everyone will be doing it. By 2030, 2035, there won't be any more automobiles using petroleum. Automobile usage is 1/3 plus of all usage. Boeing is putting out all new planes, and Airbus too, that are 15 to 20%, consume 15 to 20% less fuel. Okay, so now, so the other part of the other major users of oil, so you have 30% of the oil consumption or 40% of the oil consumption going to zero. Another 20% of your oil consumption, which is jet fuel, goes to is dropping 20%. So that's another 4%. So now you've lost 34 to 40% of your total consumption. That means now your 30 years worth of oil is now, well, let's say we're 10 years into it. So your 20-year remaining supply of oil is going to be a 40-year supply of oil to start with, but also nobody needs it. They only need half the oil you've been producing. So where are you then? What happens when you've got all this oil sitting in the ground and everybody's like, well, we only need 5 million, we don't need 10 million barrels a day, we need 5 million barrels a day. That's when you get into real price competition. And I said to them, if you want to preview that, look at coal. Because coal, 100 years ago, coal was here. 90%, 80% of our global energy consumption was coal. And boy, were the cities dirty. Okay? Way up here. Before coal, it was wood. Wood was 100% before coal came along. If you wanted energy, you burned wood. That's how you got energy. Then we start pulling coal out of the ground. Coal surpassed wood. And wood went from everything to nothing as far as energy goes. Now, you don't see wood on here, do you? I guess it's a renewable, technically. So now coal is down to 25% for a while. That's up to 30%. It's because of emerging markets, China especially, huge coal consumers, but they're cutting it back now because now Chinese cities look like London in 1890. Okay, you walk around in a white shirt and it's gray by the end of the day because of all the pollution. That's not good. And people are dying of pollution-related diseases. So China wants to cut back regardless. As you see, natural gas is climbing, right? That's good. That's one of the reasons we like natural gas. Hydro is not really a big thing, but what's coming up is renewables, of course, solar. Nuclear, not very popular right now. But what's really going to kick this into high gear, aside from the fact, see, this is the thing about renewables, though. Renewables run on Moore's Law. There will be exponential growth in renewables because the same solar cells, the same amount of space that you have in solar cells now, in 10 years will produce at least not even 10 years, but in 10 years will produce 10 times more energy for 1/10 the cost. In just 10 years. 10 times more than 2% is 20-something% in 10 years. That's going to come out of these guys. 10 more years, it'll be 50%. And these guys will be way the hell down here as afterthought energies. But then Lockheed Martin is telling you that in 5 years, they're going to give you a working fusion reactor. Commercially working fusion reactor. 5 years. What's that going to do? Then you won't need the gas. And if you don't need the gas, you can use it for everything the coal is being used for now. And we don't need the oil because the cars won't need the oil anymore, so oil will be down here anyway. And it's not going to happen all at once. It'll be over time, just like coal over time. It's 100 years for coal to drop. But if something's dropping 1% every year, year after year after year, even if it's 1% every year usage, still going to get to zero. It's still going to be very hard to maintain pricing when that happens. And you can see, and coal, even though coal, you say, oh, look, coal's doing better. Not the price of coal. Price of coal is like, boom. That's what's going to happen to oil, too. It's just not going to be an important source of energy. And you know, it's hard to say now. Of course, you're so used to it now, it's hard to say, okay? But honestly, if you look at pictures of New York, if you look at a picture of New York in 1890, it's a horse show. Everyone's getting around with horses. You look in the middle of the town, there's hundreds and hundreds of horse-drawn carriages everywhere. 15 years later, not a horse on the street. 1905, cars. 1920, 1915, cars. 1925, kids are like, what's a horse? That's how fast things change. It's going to be very interesting, very, very interesting next couple of decades, let me tell you. Anyway, U.S. election, I said over. This is line worth talking about. Segment 2, they wanted to review the trades that we made. We made these trades. We make this trades on Money Talk. That's why I come back and do it every once in a while. So the Apple trade I talked about yesterday, that's doing gangbusters. The natural gas trade, also doing fantastic. We closed this trade already because it went up so fast. We already closed this trade, but I just reported on it as if it's still in progress. Segment 3. Oh, and what's our pick for next year? It's not really my pick for next year. I got to clarify that for them though. My pick of the moment that I like is coffee. We don't do a trade of the year until we're into Thanksgiving. At the moment though, coffee is still my leading contender. The problem with coffee, though, is it doesn't have long enough options. They only go out to March. So I wrote about why global warming is messing up production, blah, blah, blah. And I said we like the futures, KC. I do. Anytime KC is at $1.50, we've made money over and over and over on these guys. Anytime they're at that 150 line or lower, we start playing it again and wait for the pop. Now, one day we're going to play it, and accidentally it's going to have a huge run, just like natural gas did. You know, if you look at natural gas, we played it and played it and played it all year. You know, we played it all this time, and then suddenly, you know, so we're having fun all the time, keep trying to play bullish and pick up bullish things and whatever, and we're doing it, and then finally, ba-boom, all in one gigantic shot. That's 240 to 3 is 25%. That's a 25% move over the line that we've been stopping out at. You know, we've been cashing out at this line for a while. Because it was high, we were like, oh, that's high enough, and we were getting out. Because all here, this line was staying at the top. All of a sudden, it went boom and flew over. Never looked back again. So in natural gas, in coffee, look at the same chart. And, well, actually, in the weekly chart, you see, it's the same thing. It's messing around down here. It's consolidating. It's going to move up over this line, and 25% of this is going to get you to right about, well, actually, exactly. It's going to get you 30% of that is going to get you to 200. And if this thing goes boom, let me tell you something also. These contracts are expensive. So if that thing moves to 200, I don't even know what the number is, but it's a lot. I know I was actually surprised. Like, I think it's almost $1,000 a penny on the coffee move. Not a penny, I'm sorry, $1,000 per dollar. So when it goes to 150, you know, when it goes to 153, that's $1,000. So this move here is $50,000. So I always want to have something long on coffee whenever possible, because that's a fantastic trade. Lost my thing. And then as an alternative, though, like I said, the problem with the ETF, Joe, is that they only go out to March. But for now, I like the March 21, short 21 puts right here. So we're holding 4 right here. So the March 21 puts and buying an aggressive 22-25 spread. So it's at 22 now. We're looking for it to be higher. We're looking for it to keep following this upward trend into the spring. And if it does that, though, this is a nice play because you only need these amounts. You only need $750 in cash, and it pays $30,000 if all goes well. And if we look on Thinkorswim, we'll see how efficient that is. We sell 50 March 21 puts. It's a little bit more of a margin play, obviously. And again, don't forget, this is only your first round. This is your first round sale because where's my drop down? Oh, there it is. Because if coffee's lower, by the time you get to March, there'll be June, and it might be September, and then you'll just roll, and you'll roll a buck low. All right, well, hang on, I'll show you in a second. So the margin's $11,000. Now, don't forget, though, you will be stuck with 5,000. 55,000. You'll be stuck with 5,000 shares at $20. It's $100,000. The margin might be 11,000, but you'll own $100,000 worth of coffee contracts, not contracts, but the ETF. So you have to seriously want to be long on coffee. But, however, let's say we had sold the 23. Let's say we had sold the 23, the October 23s, right? And we're in the money. Well, let's say we sold the 24s, $4. All right, so we sold the 24s and now they're $2. Okay? So we sold them for $1, like we're selling these guys. We sold them for $1, now they're $2, we're down $1. What do we do? Well, we could roll them to the 22s in March. So we can roll them down $2 for, it says $1.35, but that's not realistic. It's got to be more. So it's like $1.50. So we could pay 50 cents. Don't forget, we collected $1.10. We pay 50 cents to roll them down $2 in strike. And if we can do that every 6 months, we'll go down to 20 from where we, we're selling 21. So we would go down to 19, and then we go down to 17. And if you don't want to own 5,000 shares of Joe for 17, you shouldn't be in the trade as a long-term play. But we're not going to definitely buy them for 21. We're going to roll them to a lower strike if we have to. But we're doing that because we want to be in coffee long-term, because we believe that over the next 2 years, 3 years, 4 years, coffee prices have to start going up significantly. So that's why I really, really like this trade. Okay, if you don't believe in global warming, terrible trade for you. But if you believe in global warming, this is a very direct effect of global warming, that coffee production is being screwed up everywhere. And it's not just the production of the coffee, the growing conditions are changing, that makes a mess, but also the bugs that eat coffee are getting longer seasons. Like the cold doesn't come and kill them in the fall, which means they have more time to eat the coffee leaves. And the fungus that also is very sensitive to temperature, that grows on coffee and ruins the plants, is not being hurt by cold temperatures, because there are no cold temperatures. If the temperature doesn't go down until November and it doesn't get cool, that means they have 2-3 extra months to start hurting the coffee crop. It's killing everybody's coffee production. And there's not much of a solution. That's also interesting. Coffee is a fun fact. What's shown in the Big Bang Theory. Here's a fun fact. Coffee, all the coffee in the world comes from like 2 different kinds of plants in Ethiopia. It's been adapted to different places, but genetically it's almost identical. It's just really about the growing conditions. But the actual coffee itself is so similar all over the world that these bugs and funguses, once they get in there, there's like no defenses. And they spread like crazy. Very, very bad. It's an incredibly narrow genetic crop, and very sensitive. And I made a note. Wait, where's my note to her? The Climate Institute, here's the link to the study. The Climate Institute, by 2050, half the land growing coffee will no longer sustain production. So when we find a startup that's solving this problem, we should take it seriously, right? Somebody's gonna come up with like an indoor coffee growing thing, like you could, those like hydroponics or whatever it is that they're doing now for the cities. They're gonna have to start doing this with coffee. So keep an eye out for that kind of stuff. Anyway, so there's our trade on coffee, and it's 3 o'clock, and I really got to get packing. So that's it, guys. I'm going to just see if anybody has an emergency question. Moving down now. Oh, is my trade going good? I love it when I make money when I'm not looking. Oh, yeah. All right, 150. I don't like when I make too much, because I make too much too fast, and I want to cash it in. It's a weird thing, right? Because if I make a quick 250, I'm like, oh, I really should take that off the table, right? But okay, so up 115. At least it was worth hanging out in the webinar for a little while, right? We made some money. They only sponsor the show. Oh, okay. I thought they own the show. The Joe position is moving away pretty fast. Spreads are pretty wide. Yeah, I mean, look, at a certain point, we can make some adjustments, but the bottom line is it's going to be a good trade. But it's not an emergency. It's a long-term trade. So it's not an emergency you get in today. It does pull back. I mean, if you look at the fluctuations, look at this. I mean, that's crazy. That's a huge move. 148 to 160, back to 146. So really, do not rush in. Don't feel like you're missing the bus. Okay, when you start seeing 150 and it won't fall below it anymore, or it gets to 155 and it won't fall below that, that's when you might have to say, okay, I give up. I'm going to have to move up my stops and everything else. But right now, there's not even any proof that 150 is being good support. It takes a lot longer than a couple of days to say, oh, it's getting away from me. All right. Thank you, everybody, for coming. I appreciate it, and we will do this all again next week. All right. Thanks. See you tonight on TV.